Hey everyone, welcome back. Today, let's break down one of the most important concepts in trading. The difference between going long and going short. I'll keep it simple and clear. Going long. When you go long, you're buying an asset because you believe its price will go up. It's the classic buy low, sell high strategy. For example, if you buy Bitcoin at $20,000 and later sell it at $25,000, you profit from that rise in price. Long positions are all about expecting growth. Going short. On the other hand, when you go short, you're betting the price will go down. Instead of buying first, you actually borrow the asset, sell it at the current higher price, and then plan to buy it back cheaper later. For example, if you short a stock at $100 and it drops to $80, you buy it back and keep the $20 difference. Short positions let traders profit from falling markets. The key difference. So here's the main difference. One is playing with the upward trend, the other with the downward trend. Quick reminder: both strategies carry risks. If the price moves against you, whether long or short, you can lose money, so always manage your risk. And that's it, the simple difference between going long and going short in trading. In the next video, I may tell you why going long is better than going short, especially if you are a beginner. If you would like to know, tell me in the comments, or ask me if something wasn't clear about this short lesson. If you like my content, don't forget to subscribe to my channel. That motivates me to create more videos like that. Take care of yourself and see you later.